capital gains. So firstly, we should know the meaning of capital gains. A capital gain is a profit that results from investments into a capital asset, such as stocks, bonds, or real estate, which exceeds the purchase price. It is the difference between a higher selling price and a lower purchase price, resulting in a financial gain for the investor. A capital gains tax, CGT, is a tax charged on capital gains, the profit realized on the sale of a non-inventory asset that was purchased at a lower price. The most common capital gains are realized from the sale of stocks, bonds, precious metals, and property. Not all countries implement a capital gains tax, and most have different rates of taxation for individuals and corporations. As per Section 45 of Tax Act, any profits or gains arising from the transfer of a capital asset effected in the previous year shall be chargeable to income tax under the head Capital Gains and shall be deemed to be the income of the previous year in which the transfer took place. Notwithstanding anything contained in subsection 1, where any person receives at any time during any previous year any money or other assets under an insurance from an insurer on account of damage to or destruction of any capital asset as a result of flood, typhoon, hurricane, cyclone, earthquake, or any convulsion of nature, or riot or civil disturbance, accidental fire or explosion, action by an enemy or action taken in combating an enemy. Notwithstanding anything contained in subsection 1, the profits or gains arising from the transfer by way of conversion by the owner of a capital asset into shall be chargeable to income tax as is income of the previous year in which such stock in trade is sold or otherwise transferred by him. The profits or gains arising from the transfer of a capital asset by a person to a firm or other association of persons or body of individuals in which he is or becomes a partner or member by the way of capital contribution or otherwise shall be chargeable to tax as is income of the previous year in which such transfer takes place. The profits or gains arising from the transfer of a capital asset by the way of distribution of capital assets on the dissolution of a firm or other association of persons or body of individuals or otherwise shall be chargeable to tax as the income of the firm, association, or body of the previous year in which the said transfer takes place. Section 46 states capital gains on distribution of assets by companies in liquidation. Notwithstanding anything contained in Section 45, where the assets of a company are distributed to its shareholders on its liquidation, such distribution shall not be regarded as a transfer by the company for the purposes of Section 45. Where a shareholder on the liquidation of a company receives any money or other assets from the company, he shall be chargeable to income tax under the head Capital Gains in respect of the money so received or the market value of the other assets on the date of distribution. After studying this lesson, you should be able to basic concept, transfer, not regarded as transfer, long-term assets, short-term assets. Now let's discuss Section 47 stating transactions not regarded as transfer. Nothing contained in Section 45 shall apply to the following transfers. Any distribution of capital assets on the total or partial partition of a Hindu undivided family. Any transfer of a capital asset under a gift or will or an irrevocable trust. Any transfer of a capital asset by a company to its subsidiary company. Any transfer in a scheme of amalgamation of a capital asset by the amalgamating company to the amalgamated company if the amalgamated company is an Indian company. Any transfer in a scheme of amalgamation of a capital asset being a share or shares held in an Indian company by the amalgamating foreign company to the amalgamated foreign company if A. At least 25% of shareholders of the amalgamating foreign company continue to remain shareholders of the amalgamated foreign company. B. Such transfer does not attract tax on capital gains in the country in which the amalgamating company is incorporated. Any transfer in a demerger of a capital asset by the demerged company to the resulting company if the resulting company is an Indian company. Any transfer in a demerger of a capital asset being a share or shares held in an Indian company by the demerged foreign company to the resulting foreign company if A. At least 75% of the shareholders of the demerged foreign company continue to remain shareholders of the resulting foreign company. B. Such transfer does not attract tax on capital gains in the country in which the demerged foreign company is incorporated. Any transfer of capital asset being bonds or shares referred to in subsection 1 of section 115 AC made outside India by a non-resident to another non-resident. Any transfer of agricultural land in India effected before the first day of March 1970. Any transfer by way of conversion of bonds or debentures, debenture stock or deposit certificates in any form of a company into shares or debentures of that company. Any transfer made on or before the 753 CA 31st day of December 1998, 753 CA by a person not being a company of a capital asset being membership of a recognized stock exchange to a company in exchange for shares allotted by that company transferor. Any transfer in a scheme for lending of any securities under an agreement or arrangement which the assessee has entered into with the borrower of such securities and which is subject to the guidelines issued by the Securities and Exchange Board of India. Now let's discuss computation of capital gains, which is covered under section 48 to 51. The income chargeable under the head capital gains shall be computed by deducting from the full value of the consideration received or accruing as a result of the transfer of the capital asset the following amounts, namely 1. Expenditure incurred wholly and exclusively in connection with such transfer. 2. The cost of acquisition of the asset and the cost of any improvement thereto. Provided that, in case of non-resident Indians, the cost of acquisition, the expenditure incurred wholly and exclusively in connection with the transfer and full value of the consideration are to be converted into the same foreign currency with which such shares were acquired. Where long-term gains arise in the hands of residents, capital gains shall be computed by deducting indexed cost of acquisition, indexed cost of improvement, and transfer expenses from full value of the consideration received or accrued as a result of the transfer of the capital asset. Provided also that nothing contained in the second proviso shall apply to the long-term capital gain arising from the transfer of a long-term capital asset, being bond or debenture, other than capital indexed bonds issued by the government. Provision for full value of consideration in certain cases are where the consideration received or accruing as a result of the transfer by an assessee of a capital asset, being land or building or both, is less than the value adopted or assessed by any authority of a state government for the purpose of payment of stamp duty in respect of such transfer, the value so adopted or assessed shall, for the purposes of section 48, be deemed to be the full value of consideration received or accruing as a result of such transfer, without prejudice to the provisions of subsection 1, where the assessee claims before any assessing officer that the value adopted or assessed by the stamp valuation authority under subsection 1 exceeds the fair market value of the property as on the date of transfer. The value so adopted or assessed by the stamp valuation authority under subsection 1 has not been disputed in any appeal or revision, or no reference has been made before any other authority, court or the High Court. Subject to the provisions contained in subsection 2, where the value ascertained under subsection 2 exceeds the value adopted or assessed by the stamp valuation authority referred to in subsection 1, the value so adopted or assessed by such authority shall be taken as the full value of the consideration received or accruing as a result of the transfer. Expenses incurred wholly and exclusively in connection with such transfer refers to expenses necessary for effecting transfer, as for example, brokerage, commission paid for securing a purchaser, cost of stamp, traveling expenses incurred in connection with transfer, litigation expenditure for claiming enhancement of compensation, etc. The cost of acquisition of an asset would normally be taken to be the price at which the asset was acquired by the assessee. Such price may include the price paid to the vendor, buying expenses, transportation charges, the cost of installation of the asset, litigation expenses incurred for having the shares registered in his name is part of the cost of acquisition, and that incurred for gaining better voting rights is cost of improvement. Where the capital asset being a share or shares in an amalgamated company, which is an Indian company, became the property of the assessee in consideration of a transfer referred to in Clause 7 of Section 47, the cost of acquisition of the asset shall be deemed to be the cost of acquisition to him of the share or shares in the amalgamating company. Notwithstanding anything contained in subsection 1, where the capital gain arising from the transfer of a capital asset referred to in Clause 4, or as the case may be Clause 5 of Section 47, is deemed to be income chargeable under the head capital gains by virtue of the provisions contained in Section 47A, the cost of acquisition of such asset to the transferee company shall be the cost for which such asset was acquired by it. Cost of improvement means all expenditure of a capital nature incurred in making any additions or alterations to the capital asset by the assessee after it became his property. Where capital asset has become the property of the assessee by any of the modes specified in Section 49I, the expenditure incurred for the purpose by the previous owner. Cost inflation index is a measure of inflation that finds application in tax law when computing long-term capital gains on sale of assets. Section 48 of the Income Tax Act defines the index as what is notified by the central government every year, having regard to 75% of average rise in the consumer price index for urban non-manual employees for the immediately preceding previous year. Formula for computing index cost is index for the year of sale divided by index in the year of acquisition. Now let's discuss capital gains exempt from tax. If the new asset is not acquired under sections 54, 54B, 54D, 54F, 54G and 54GA, or the full amount could not be invested up to the due date of furnishing the return of income, the assessee can deposit the desired amount under the capital gains scheme on or before the due date of return, and thus can acquire the asset within the stipulated time out of money withdrawn from such scheme at a later date. In the case of Section 54 EC, the capital gains scheme is not applicable. Consequences if the new asset acquired is transferred within 3 years of its acquisition under Sections 54, 54B, 54D, 54G and 54GA. For computation of new capital gain, the cost of acquisition of such new asset shall be reduced by the amount of capital gain exempt under Sections 54, 54B, 54D and 54G earlier. Under Section 54F, besides the new capital gain, the capital gain exempt earlier under Section 54F shall be long-term capital gain of the previous year in which new asset is transferred. Under 54EC, if such security acquired is converted into money or any loan is taken against such securities within 3 years, the capital gain exempt under Section 54EC for such securities earlier shall be long-term capital gain of the previous year in which such conversion takes place or the loan is taken. Consequences if the amount deposited in capital gain scheme is not utilized within the stipulated time of 3 years, 2 years in case of Section 54B. The unutilized amount shall be capital gain, short-term or long-term depending upon original transfer, of the previous year in which such period has expired. However, in case of Section 54F, proportionate amount shall be taxable. Now let's discuss tax on long-term capital gain, where the total income of an assessee includes any income arising from the transfer of a long-term capital asset, which is chargeable under the head Capital Gains. The tax payable by the assessee on the total income shall be the aggregate of, in the case of an individual or a Hindu undivided family and domestic company being a resident, the amount of income tax payable on the total income as reduced by the amount of such long-term capital gains had the total income as so reduced been his total income. The amount of income tax calculated on such long-term capital gains at the rate of 20%. In any other case of a resident, the amount of income tax payable on the total income as reduced by the amount of long-term capital gains had the total income as so reduced being its total income. The amount of income tax calculated on such long-term capital gains at the rate of 20%. Where the gross total income of an assessee includes any income arising from the transfer of a long-term capital asset, the gross total income shall be reduced by the amount of such income, and the deduction under Chapter 6A shall be allowed as if the gross total income as so reduced were the gross total income of the assessee. Where the total income of an assessee includes any income arising from the transfer of a long-term capital asset, the total income shall be reduced by the amount of such income, and the rebate under Section 88 shall be allowed from the income tax on the total income as so reduced. Now let us check if you have understood the various concepts discussed in this lesson clearly. A capital gain is a profit that results from investments into capital asset such as stocks, bonds, or real estate, which exceeds the purchase price. Right or wrong? Right. As per Section 46 of Tax Act, any profits or gains arising from the transfer of a capital asset effected in the previous year shall be chargeable to income tax under the head Capital Gains and shall be deemed to be the income of the current year. Right or wrong? Wrong. The cost of acquisition of an asset would normally be taken to be the price at which the asset was acquired by the assessee. Right or wrong? Right. Now let's revise what we have studied till now. Capital gain is a profit that results from investments into a capital asset. The basis of charge for capital gains is provided under Sections 45 and 46 of the Income Tax Act. Section 47 covers the transactions not regarded as transfer, while Section 48 to 51 covers the computation of capital gains. Depreciation is a non-cash expense that reduces the value of an asset as a result of wear and tear, age, or obsolescence. Equity is the ownership interest in a corporation in the form of common stock or preferred stock. Rebate is the money that is remitted by the federal government to a taxpayer.